So we're really going down the 1040. So we learned in chapter 1 about the big tax formula. In chapter 2, we learned about a lot of the premises around gross income. And now we're starting to really dial into the specifics. If you have business income and expense, what schedule does it show up on? C. Shows up on the schedule C, right? So we're going to be spending a lot of time with the C. You should probably either have one up on your screen at irs.gov. I mean, I don't think you need to do it for 20 minutes here. Or you should have one out in front of you. Another part, yeah, okay, so this is all going to be just totally Schedule C. So page 3-9 is the C. Let's just start by taking a look at one, honestly. So if you could turn to page 3-9, or if you don't have your book, bring one up on irs.gov. And if you would, please just take a second and look at the Schedule C and see what's interesting about it, or what's the layout of the Schedule C. I mean, it's really a P&L, isn't it?
Oh, yeah, it's just like an income statement.
So your part 1 is your gross receipts minus your COGS equals your gross profit. Then minus all of your expenses takes you to line 29, tentative profit or loss. Then on line 30, we have this special thing called expenses for use of your home. In tax lingo, that's called OIH, office and home. And then we come down to net profit or loss. That's the amount that you pay FICA on. That's the amount that carries to the face of the 1040. If you go to the second page, it's got your cost of goods sold model, beginning balance plus purchases minus ending inventory. There's your COGS. In part 4, they want to know about your vehicle. Right, if you're taking auto expenses, what year, how many miles did you drive? Have you documented your usage? And then part 5 is for all the quote unquote other expenses that they don't specifically line out here. So they line out all the basics, rent, utilities, payroll, if you have stuff like computer expenses or whatever that just doesn't fit neatly into these categories that go on the second page.
So, that example that we had is with the $300, the tax return was done in exchange for hair.
Yeah.
Would you put that under other expenses as far as because you gave away your services?
No, I put that under income. That's taxable income.
I'm talking about like he also did a service.
Oh, yeah, you can't,
just can't deduct that. Huh?
And this really makes clients crazy. Like, I've got a gal that's a weaver. She does these beautiful weavings and clothes, and she takes them all over the Northwest to trade shows. And then she'll give a gift, say, to the youth homes to auction off a scarf, a $100 scarf. And she's like, I want to write that off. You can't write it off because the yarn has already gone through cost of goods sold, so it's an expense. And the value of your time is not deductible. So if I do pro bono work for like the food bank, if I do their tax return for free, I can't write that off. Okay? Okay. Now make sure that you understand this is kind of a weird calculation. If you get down to that line 31, right, where you've got your net profit or loss, just to make a nice, neat, even number. What kinds of taxes should you have to pay on that? You're going to pay SE tax. And what else?
FIT.
Yeah.
Yeah.
Yeah. And probably so. Now, what rate is SE tax for both shares? 53. But this is the weird part of the calc. And I'm not going to go into the weeds about why we do it like this, but just you need to know it. It's not just nice and easy like 10,000 times 15.3%. I'm not going to explain it, just learn it. This is how you make the calculation. And that all goes on a Form SE. And then you'll also see that you have a deduction for AGI for half of SE tax. You know what I'm talking about on the face of the 1040?
You can deduct it from your federal obligation, is that right?
From your, it reduces your AGI. It's one of those like 10 things on the bottom of a 1040, deduction for AGI. You see that, Phil?
Yeah.
So that's whatever this number is, you know, obviously, times 50% is your deduction for AGI. And so if you're listening, you can't see the board, it's your income from your Schedule C times 0.153 times 0.9235. Which that's 100% minus 7.65, which is half. Okay. So at the end of this chapter, we're going to hopefully be able to complete a basic Schedule C, do COGS, and understand all the nuances to deducting travel, meals and entertainment, transportation, all sorts of stuff like that. Dues and subscriptions, etc. Okay, first off, how do we define a trade or business? This is a hugely, not controversial, but it's a hard thing sometimes to explain to clients. So I've got a gal that I'm dealing with right now that's gotten audited, who had done her own tax return for the last 3 years. She's studying to be a yoga teacher. So she's going, and this is very popular now, you go to very expensive places, Costa Rica, Mexico, and Indonesia, and you go to these $10,000 classes to get your 500 hours to become a yoga teacher. And now she's back, and when you get paid $20 an hour in Missoula to teach yoga. So she's making $100 a week teaching yoga, and then she writes off a $10,000 trip to Bali. Okay? Does she have a trade or business? She's like, I'm certified. I'm a yoga teacher, making $20 an hour doing it. It's a hot, and for the 2 years before it, she wrote off the trips to Costa Rica and Mexico. She's got a hobby that happens to pay her $100 a week for 20 weeks a year. Okay? Go to Cambodia, spend $8,000 going on a trip to Cambodia, come back, and someone's like, oh my God, I love that photo you took. Will you blow it up and sell it to me for $500? Sure. Do I have a trade or business? No. A trade or business is generally an activity conducted for a profit. If you're making $20 an hour and spending 10 grand a year to keep your hours up, is that engaged in for a profit? No. So what I'm saying is that a lot of things that people think are a trade or a business are a hobby. And the IRS basically defines that as you have to show that you've made a profit 3 out of the last 5 years. So if she had a studio and she was making 40 grand a year at her studio, she could write off the $10,000 trip to Bali. But she's not engaged in it for profit. Okay? And for a deduction, so this was tough to explain to her. She owes a shit ton of money back. For something to be considered deductible for a trade or business, this is really the lens. Is it ordinary and necessary? In any situation, forget Bali, forget the yoga, is it ordinary and necessary to incur a $10,000 expense to make 5 grand a year? Is that ordinary and necessary in most situations? Of course not. Does it have a legitimate business purpose? And is it reasonable in the light of the fees generated? Another guy that he got had been doing his own tax returns. He was a videographer, and he has tens of thousands, if not hundreds of thousands of dollars of very expensive equipment, camera equipment, editing equipment, computer equipment, that he was writing off against like $8,000 a year of services, right? So he was selling his services for $7,000-8,000 a year, and then writing off a $30,000 camera. Well, no, that's really a hobby that you happen to generate a little bit of money on. So that's all disallowed.
If you do, over time, start generating profits in the next 5 years,
Yeah.
you bought in the first year, can
Yeah.
you then write off that camera year, or?
And okay, that's a great question. And I've looked into this, and basically the code is very vague on it, but I do. I've got a drummer who I was, bought a really expensive drum set, and then, was just doing like you do, going around basically playing for free and making, $50 at the top hat or something. And he connected with Jeff Ament from Pearl Jam. And now he's like playing real music and making real money. And so I'm like, there really wasn't great guidance, but he had like an $8,000 kit. So yeah, last year he got, $80,000 W-2. Hell yeah, I'm going to write it off. But it wasn't clear, honestly. Something that was purchased that many years prior should have been written off. That's the kind of stuff like, yeah. I just kind of do because I feel that it's right.
Figure it out if it gets audited.
Figure it out. And again, the other thing is no one's coming back and auditing a kid with an $80,000 W-2. Okay, they're going after people that are offshoring 7- and 8-figure companies. You come back and audit a kid that has an $80,000 W-2 with an $8,000 drum kit, and they might eke out another $2,000 of tax, right? Is that where we want our IRS auditors pursuing? So it's not worrisome to me. Okay, if you have a sole proprietorship, so it's just you file a Schedule C for a long form, or a CEZ for a short form, and that means like you have no employees, you have no inventory, you have no depreciation. It's just like super, super basic. Okay, gambling winnings. Nobody reports these to you unless they have more than $1,200 a year from one place. If you win more than $1,200 a year from one place, you're going to get a 1099-G. So if you walk into the Quatucknuck and you win $5,000, the lights are going to go off, and they're going to come bring you a drink, and then they're going to give you a W-9 to fill out your social security number and your address. And you're going to get a 1099-G. If you go and hit $500 10 times during the year, believe me, you're not bringing that to your accountant. So I'm only going to know about it if you have a 1099-G. Those do not go on a Schedule C because you don't want to pay self-employment tax on it. The only time it goes on a C is if you're a professional gambler.
I can't believe there's such a thing as a professional gambler.
Oh, there totally is. Are you kidding? Oh my goodness. Yeah.
That's what they do for a living.
That's what they do for a living. We actually had a kid from Malaysia that was going to grad school here live with us when we first bought our house because we couldn't afford the mortgage. And he was a professional gambler in Missoula. He would go to, I don't even know where he was, the Lucky Strike and the Ox at the card tables. And he was a Chinese Malaysian kid, and he was a professional gambler. That's how he made his living.
Wow. That's a new one on me. I didn't know that.
So you have to report your gambling winnings on a 1040. If you have gambling losses, you can take them, but only up to your gambling winnings. So it can only net out to zero is what I'm saying. If I go lose 10 grand, I can't write that off. I can only write that off if I've recorded 10 grand of income. So I can net it out. Okay, self-employment tax. Is your book using the 118.5 number? Do you know for Social Security? This is what's so hard to keep at. It's 127.2 now. But I just say we have to use whatever numbers in the book and the software.
Well, and right now, your PowerPoint is a different version than the PowerPoint you have listed on our Moodle. The one that's on our Moodle right now is orange background and it has 12.4%.
Oh, gosh, see, I'm sorry. I'm just, this is completely my bad. Okay, so nothing else has been different until now, huh? Okay, thank you. It's back to this issue, isn't it? That I'm not using the right, but I don't, okay. Oh, slides. PowerPoint's 2018. There you go. That would explain that. Yeah, when you see me doing this, it's make sure that I switch it up. There we go. Are we on the same page now? Okay. 127.2, 2.9% of all your net earnings, and of course those numbers are 6.2 plus 6.2 is 12.4, 1.45 plus 1.45 is 2.9, and then you get a deduction for AGI equal to half of the SC tax, and we just talked about that. And then there's a 0.9% Medicare surtax if you make more than $200,000 single and $250,000 married filing jointly. Inventory. Okay, COGS. I showed you that. I think it was on part 3 of your Schedule C, right? And you might remember this from just like Accounting 101. Beginning inventory plus purchases minus ending inventory is COGS. But there's very different cost allocation schemes. You can do LIFO or FIFO or weighted average. What does LIFO stand for?
Last in, first out.
Okay, last in, first out. Is that going to give you a higher cost of goods sold or a lower cost of goods sold in periods of inflation?
Higher.
Last in, first out says the last stuff in the door is the first stuff sold. So what's technically in my inventory? The new stuff or the old stuff? The old stuff. So the new stuff has gone through COGS. In a period of inflation, that's higher cost. So what does that do? It increases my COGS and it decreases my net income, right? So like 95% of everybody uses LIFO because it gives you a bigger tax break now. What else? That's about all I've got to say there. Okay, transportation. Transportation is if you're not away from your tax home. And we'll define tax home in a minute. But I mean, for most of us, our tax home is like literally our home. But you can have a tax home different from your home. We'll talk about that in a sec. But basically, to get a transportation expense, you're not away from your tax home. So what are we talking about? Because we know commuting's not deductible, right? The cost of getting to and from your job isn't deductible. But there are exceptions to that. So commuting is never deductible except if you're traveling between your house and a work locale that's outside of the metro area that you live in. So my son lives in East Bay, right? San Francisco, East Bay, and he normally works in San Francisco. But now they send him down to Fresno. So he's still like, oh, that's way too far, Stockton. So he's still, it's a day trip. I mean, he's going down there to visit a building site and come back, but it's outside of his regular area. So does he get to deduct that?
Yeah.
Sure. I mean, that's a bad example because he's employed. But if he was self-employed, traveling between home and a temporary workplace when you have a regular place of business, or when you go out your front door, if your office is in your home, everything's deductible. So like my tax practice is in my house. So if I go to meet a client for lunch, the minute I walk out my front door, that's deductible because I don't have another place of business. Does that make sense? And then you can always deduct the cost of hauling anything. I'm hauling my tools, I'm hauling my drum kit, I'm hauling my, my drywall, whatever. If I've got, the cost of hauling that stuff is always deductible, even in my local area. So they give you a mileage amount, and I think this is on the inside of your back flap. It changes every year. depending upon what, gas prices are doing. So I get 53.5 cents a mile for every mile I travel, plus God bless, the business portion of any parking or tolls or license plates, plus my auto loan interest if I'm self-employed.
It is now, that was 2017.
Isn't it right?
It's 54.5 cents per mile now for 2018.
In the current year.
Yeah.
Right. So we're just going to use what's in the book, otherwise we'll get super confused.
Yeah.
As if I'm not already super confused, I've just been using slides from the whole prior year. So what I'll say to a client is log your miles so I can see how many, I can multiply that by 53.5 cents. Plus keep your parking receipts. So you go to business luncheons or conferences and you have to, pay $18 to park in the parking garage downtown. Save that. We don't really have tolls here, but in many major metropolitan areas in the whole East Coast, essentially you pay tolls everywhere you go. Save that. Then your license plates are $300. Okay. I can take a portion of that, your business portion of how much you drive your auto. And if you finance your car, I can take a portion of that interest if you use your car for business. Okay. So that's if you go actual. Or, okay, well, let me finish this. So in order to use this, not actual, that's standard. If I'm going to use the standard methodology, I have to comply with these 4 things. I own or lease my car. These next 3 are sort of esoteric. Don't worry about those too much. So basically, most people can take standard if they want. So I'm going to run the numbers on that. It's almost always more lucrative to take standard rather than actual. Almost always. I think I've got like 2 people that I've got on an actual deduction for their cars. Additionally, up in that very first bullet, you can take planes, rail, bus, anything in your local area. Or if you don't want to take that standard that I just talked about, that 53.5 cents plus the parking tolls, interest, and plates, you can take actual expenses, and that's like you've got to log every time you fill up your gas tank. You got to log every time you get oil change. You got to log every time you get your tires rotated. And that will very rarely, 53.5 cents a mile is really a generous allocation unless you got a car that gets, 8 miles to the gallon or something. It's pretty generous. So I do have a very few clients that take actual, but I'll pencil that out the first year, and normally I will recommend they go to standard. So really all I need from them is their mileage at the end of the year. I drove 12,000 miles, and I think 8 of them were business. Okay, and that's all fine until you get audited, and then you've got to produce some sort of log. Okay, great. Get 5 colored pens and make a log. It's no big deal. But most people, they estimate. I try and get them to do at least beginning and ending odometers readings at the beginning and end of the year, so at least I have a count on that. Okay, and actual expenses, all these things I just told you. And then I'm just going to finish up by saying that your car expenses can go one of 2 places. So we're talking here about self-employment income. If you've got a car and you're self-employed, it's going to show up on line 9 on your Schedule C. Okay. And that can be standard or actual, whichever methodology you use, but that's where it's going to show up, right, line 9. And then you would have to flip it over and fill out part 4, which is that information on your vehicle. Alternatively, can you write that off if you're an employee? Can you write off your mileage that you drive on behalf of your employer? I'm not self-employed.
Yes.
Sure you can. Can't write off the commuting, But like, I've got a friend who's a physical therapist, and he goes in the morning and he gets his charts and directives for the day. And then he drives all over western Montana. I mean, he might be up in Mineral County, might be down in Hamilton. He works for Community Hospital, but he's an employee, but he drives, it's 15,000 miles a year in his car. He fills out, there's two places your auto expenses can show up. It can show up on line 9 of your Schedule C if you're unemployed. Or if you're an employee, it's going to show up on your Schedule A as an itemized deduction. And you fill out a Form 2106, and that flows to your Schedule A as an itemized deduction. Okay, so, yes, sir.
If you're not being reimbursed.
Well, okay, that gets a little bit more complicated. If they reimburse you and it shows up on your W-2, then you still get to deduct it on your tax return as an itemized deduction.
Because it was that insurance.
Yeah. Yeah. Okay, let me stop this and we'll talk about really quick what's going on for the weekend.